welcome back traders to our short series on how to master your entries and exit levels. In our recent episode, I promised that this episode was going to be the last one, but on a second thought, there is an important concept or idea to note, and that is why being a good analyst alone isn't enough. I mean, you can actually predict the direction of the market correctly and still lose miserably during execution. Without further ado, let's hit the grounds running. In financial trading, many people assume that being a great analyst, I mean someone who can predict the market trends and understand economic data, will naturally lead to profitability. However, while analysis is essential, trading is more than just analysis. You can have a great understanding of the market, but if your entry and exit points aren't properly managed, you may still lose money. Here is why. In fact, 7 key points to note. You might have to take your pen and your writing pad. 1. Theoretical knowledge versus real-time execution. As an analyst, you might be able to predict that the market will go up or down, but executing trades in real time is where the challenge lies. The market moves fast, and you need to decide when to enter, buy or exit, sell within a specific time window. A delay of just a few seconds can be the difference between a profitable trade and a losing one. For example, if you analyze that a stock will go up, but you entered the trade too late after the initial upward move, you will lose the optimal point of entry. Even worse, the price might already be close to peaking, and you could end up buying right before the market reverses. 2. Risk management is tied to entries and exits. One of the key principles of risk management is controlling your losses. This is done through stop loss orders, which you place at specific exit points to limit losses, and knowing when to take profits. If you don't set proper exit points, you risk holding onto trades that should have been exited earlier, leading to bigger losses. You might be right in your analysis, but if you don't properly or clearly define entry and exit strategies, you could find yourself losing more than you win. Traders often say, you can't go broke taking profits, which highlights the importance of exiting trades at the right time, even if it means accepting smaller profits. 3. Emotional discipline at entry and exit points. Successful traders emphasize that controlling your emotions is key. Knowing when to enter or exit a trade often tests your emotional discipline. The fear of missing out, FOMO, might cause you to enter trades too early or too late. Similarly, greed can prevent you from exiting a profitable trade at the right time, causing you to hold on until the market reverses against you. Let's say your analysis suggests a bullish market, and you enter a trade, but the market stalls. If you let emotions take over, you might abandon your stop loss plan, hoping the market will turn into your favor. By the time you act, it could be too late. 4. Timing the market. Now, as the saying goes, timing is everything. In trading, even if you are a skilled analyst, identifying when to get in or out of the market is difficult. Timing comes down to understanding both technical and fundamental factors in the market. For example, we have 2 sub-points to note: technical indicators. Tools like moving averages, candlestick patterns, and support or resistance levels are vital for timing your entries and exits. 2. Fundamental events. Economic releases, interest rate changes, or geopolitical news can instantly change market conditions. An analyst might know the general direction of the market, but may still mistime a trade if they don't consider these real-time factors. 5. Profits isn't only about being right in trading. It is not about being right, it is about managing your trades effectively. You can be right in predicting the market direction, but if your entry point is poor or your exit point is too late, your trade won't be profitable. For example, you might correctly predict a market rally, but if you enter after the initial move, you will be buying at a higher price, leaving less room for profits. Similarly, if you hold a winning trade for too long, hoping for a bigger gain, the market could reverse, turning your profit into a loss. Now, 6. Entries and exits define risk to reward ratio. Your risk to reward ratio, how much you stand to gain versus how much you risk losing, depends on carefully chosen entry and exit points. A good analyst might see a high profitable trade, but without setting a reasonable take profit target or a stop loss, they may expose themselves to unnecessary risks. For example, a trade with 1:3 risk to reward ratio, risking $100 to gain $300 only works if the entry and exit points are well defined. If you enter too late or exit too early, you reduce your potential reward, and the ratio is no longer favorable. 7. Market conditions change constantly. Analysts can base predictions on past performance, but markets can change quickly due to news, economic data, or even unforeseen events like natural disasters or political instability. A trader's ability to adapt to these changing conditions by adjusting their entry and exit points accordingly will largely determine their success. Even if you are an excellent analyst who identifies the right trend, failing to adjust your strategy to new market conditions will prevent you from maximizing profits or avoiding losses. Conclusion. In summary, being a good analyst is like being a good analyst actually is critical to understanding the market and its movements, but execution is key. Your analysis is only valuable if you can apply it in real time with disciplined entry and exit strategies. Understanding when to enter and exit a trade and sticking to your plan determines whether you will be a consistent, profitable trader. Right. Let's wrap up. Now that we understand why analysis alone isn't enough, we will take it further into our next video, where we will look at real charts and strategies to help you master those critical and exit levels. Right, so stay tuned for the practical, the climax of this video series in our last episode. See you soon. Stay tuned. Bye for now.